Major indices having a strong month here. The Nasdaq and the S&P 500 having their best run since November. To break down where you should be potentially cashing into the rally here, we've got Nora Yousif, who is the RBC Wealth Management Vice President and Financial Advisor. Nora, great to see you, and thanks for joining the program with us here this morning. We got to know, when people are thinking about, of course, the age-old adage of sell in May and go away, it seems like there's quite a few buying opportunities that investors have really been trying to tap into. Where are some of the maybe not overcrowded, but still ripe opportunities in the market?
That's right, Brad. The obvious one is tech. With AI in its infancy stages, AI is the buzz term now. Next will be quantum computing. We've all heard what it can mean for productivity and how it's going to be more impactful than the previous industrial revolutions. The naysayers are saying things are frothy. I don't disagree, but things aren't as expensive as they were during the dot-com bubble that everyone's so scared of. Back then, the four horsemen stock, Intel, Microsoft, Cisco, Dell, that powered the tech soar, their combined PE was a whopping 80. Today, the Magnificent Seven's combined PE is about half that. And this rally is fueled by established firms with years of profits in the books, long operational track records, and that's a stark contrast to back then. The second I'd point out, perhaps less obvious, REITs. They were experiencing an inverse relationship with interest rates. They took a beating in 2022 as rates were janked up to combat inflation, which peaked over 9% in June of 2022. It was down most of last year. It only flipped up positive about 10% at the very end of last year on the idea of the Fed starting to lower rates. And when that didn't happen this year, it's back down and still on sale from its all-time high. So remember, the key to being a good investor is being a contrarian and seeking out what's out of favor. And lastly, I'd point out fixed income. We are at 23-year highs, folks, on interest rates right now. So consider seizing that opportunity before the window of opportunity closes on us as the Fed lowers rates. And that means buying up things like treasury bills, CDs, bonds, particularly municipal bonds if you're in a high tax bracket. So that way you don't get hit with income and potentially state taxes.
Certainly. And so, Nora, as we're kind of thinking about those different elements of the market that investors could be and should be perhaps evaluating or even taking on some positions within, where should they be perhaps fading some of their exposure?
Well, everyone's worried about inflation. And yes, we had a good inflation reading last month here. But in short, the worries aren't really behind us just yet. So inflation really is a big part of your decision. Inflation is a stubborn thing, not unlike trying to lose weight. Those last few pounds or two are usually the hardest. It's the same thing with where we are with inflation, and getting down to 2% sounds easier than it is, even though we're hovering in the threes. April was just one data point in the right direction. We had several months that were hotter than expected, busting people's hopes that we'd have a Fed cut by now. PCE is what the Fed pays attention to. CPI is what us consumers feel. And when you add in back food and energy, that came in hotter than expected. And there's inflationary headwinds to consider too. So when you talk about fading away, take this with a grain of salt. Fiscal policy, where the money is being spent. We've got student loan forgiveness program in full swing here, plus the CHIPS Act in infrastructure. I believe we're scheduled to spend over $100 billion by year end. And folks, that is inflationary.
When consumers typically feel like this, and I'm looking at some of the data from the conference board and the consumer confidence data that came out this morning, saying compared to last month, confidence improved among consumers of all age groups. In terms of income, those making over 100K expressed the largest rise in confidence, but 6-month moving average basis, confidence continued to be highest among youngest, the under 35s, and then the wealthiest consumers as well. What does that all mean and correlate for investors who are trying to figure out, okay, where in my own confidence do I still feel confident purchasing or buying into the broader markets right now?
Yeah, you brought up a great point, Brad. And here's the thing. You want to make sure your risk appetite here is in line with your investments, especially now that people are feeling really confident, because we are in a point in time that is less volatile than usual. And that's dangerous because it tends to lull investors into complacency. What's happening is people are just frankly getting too comfortable and confident, where we've had relatively less volatility in the past 18 months, where the S&P 500 was down over 2% only once, when on average over the past 20 years, we've encountered and experienced this at least 12 days each year where the S&P 500 is down over 2%. So be mindful of that as an investor. Another thing too, as an investor, you want to assess your portfolio, make sure you're diversified. We'll hear why diversification is good. So this way, when the market finally does pull back or you have extra cash to put to work, you know exactly what you're buying. And the more diversified you are, generally the more consistent, predictable returns you have over time.
Nora Yousif, who is the RBC Wealth Management Vice President and Financial Advisor. Nora, great to see you. Thanks for joining us.